Welcome. In this video, can Zbcn coin go up 370%? We will analyze this. Don't forget to subscribe, like, and please watch to the end to understand.
In cryptocurrency market technical analysis, the formation of price movements within specific structures plays a critical role in identifying both opportunities and risks for investors. One of these structures is when the price moves along a rising curve. Especially if this curve has a steep upward slope, it signals a strong upward momentum that attracts investors' attention. However, while such steeply inclined structures represent the strength of the rally, they can also be fragile and must be carefully analyzed. If the price reacts upward after touching this rising curve without breaking it, it may indicate that the positive trend is continuing in a healthy manner. Rising curves typically show that the price is increasing over time at an accelerating pace. This structure often suggests that buyers dominate the market, supply is limited, and demand is steadily rising. If the curve is particularly steep, it can indicate an extraordinarily strong appetite for buying in the market. However, this steepness also presents a test for the sustainability of the trend. By nature, markets need corrections at certain intervals. Therefore, the possibility of sudden pullbacks in such steep curves should not be ignored. If the price continues along this steep rising curve without breaking it, moving just above it and bouncing upward after occasional touches, this generally indicates a strong trend. These types of movements instill confidence in investors because the market respects support levels and targets higher highs after each touch. Preserving this curve without a breakdown also signals that large investors are still holding their positions and that buying pressure remains in the market. From a psychological perspective, a price movement that touches a steep rising curve and then climbs higher suggests that buyers are gaining confidence and selling pressure is only temporary. In technical analysis, this behavior often resembles a parabolic rise. If these parabolic structures are sustainably supported, prices can experience significant increases. However, even the slightest break can lead to sharp declines, so continuing along the curve is a strong advantage, but breaking it should raise caution. Each touch of the curve is essentially the market testing itself. During these touches, market participants look for answers to questions like, does this level truly act as support? Are buyers strong enough at this level? Are sellers trying to break this level? If the answers are supportive, the price continues its upward trend. Thus, the steep curve also serves as a psychological boundary. As long as it's not broken, market participants maintain their hope and positions. Any break below this curve typically acts as a stop-loss trigger. A break of a steep curve suggests a disruption in the market's psychological structure. In this case, investors may turn to panic selling, leading to a sharp price drop in a short period. Therefore, any movement below a steep curve is risky and should prompt investors to reassess their positions. However, if higher lows continue to form after each touch of the curve, meaning the price reaches higher levels with every bounce, this is another sign that the uptrend is proceeding in a healthy manner. In this case, the market becomes progressively more prepared to test higher levels, and each touch can be seen as a new buying opportunity. These types of formations also align with the higher lows pattern, which is a classic technical indicator of strong uptrends. While the market moves along these types of curves, volume should also be closely monitored. If the upward movement after each touch of the curve is supported by increasing volume, it shows how committed and strong the buyers are. Especially if volume continues to rise, it offers an important confirmation signal that the price may continue its upward momentum. However, if volume is declining, it shows that investors are cautious and expecting a correction. Therefore, upward movement along a steep rising curve alone may not be sufficient. It must also be evaluated in terms of volume support. In conclusion, a price advancing along a steep rising curve indicates that the market has positive momentum. As long as this curve is not broken, it signals that investors are confidently holding their positions and maintaining bullish expectations. Every touch of the curve is a test of market strength, and as long as these tests are passed successfully, the uptrend may continue. However, it should be remembered that every upward structure eventually comes to an end. For this reason, while the price continues along this curve, technical indicators, volume structure, market psychology, and support resistance levels must be carefully analyzed. A disciplined and attentive approach from the investor will allow them to make the most of possible opportunities. But we can't rely on the curve alone to make decisions. Let's take a look at the other metrics as well. Stay tuned.
I'm interrupting the video for a moment, friends, because BitTunex Exchange has a great campaign.
Here's how it works. After registering on the exchange via the link in the description and completing KYC, if you deposit $100 for your first deposit, you will receive a $20 bonus. If you deposit $500, you will receive a $100 bonus, and if you deposit $1,000, you will receive a $200 bonus. I think this is an excellent opportunity for leverage trading. For more details, you can read the articles below. The link is in the description.
In Bollinger Bands analysis, a price move above the upper band followed by a slight pullback is often considered a completely normal technical development due to the nature of the market. This structure represents a resting or cooling off phase after a sudden upward price movement. Bollinger Bands operate on the principle that prices tend to move within a certain standard deviation range, typically consisting of a 20-period moving average and bands plotted 2 standard deviations above and below this average. The bands reveal both market volatility and potential overbought or oversold conditions. When the price touches or surpasses the upper band, it usually indicates an overbought condition and suggests that a correction might follow soon. However, this doesn't always mean a downtrend will begin. Rather, it often signals a pause for the market to regain strength. In the current analysis, the price moving above the upper band shows the presence of strong buying pressure in the market. Thanks to this pressure, the price was able to break through the upper limit of the Bollinger Band, indicating significant short-term momentum. However, in such rapid rises, it's inevitable that profit-taking or new buyers waiting for better entry points will step in. Therefore, a short-term pullback is a healthy development. Even if this pullback extends to the middle band, it doesn't disrupt the positive structure. Since the middle band represents the 20-day moving average, the price approaching this level brings up the potential for a technical bounce from support. A renewed upward move after the pullback indicates that the market is still in an uptrend. The upper Bollinger Band serves not only as resistance, but also as a target level. When the price first hits this band, investors often realize profits, so a slight drop is normal. However, if there is still strong demand, the drop is usually short-lived. If the price recovers and heads back toward the middle and upper bands, the bands begin to widen. Band widening indicates increased volatility and signals that the market is preparing to define a new direction. If that direction is upward, the price may continue to move outside the Bollinger Band, which indicates a phase of accelerating trend. Additionally, a move above the upper band followed by a pullback often results in short-term corrective structures like flag or pennant formations. In technical analysis, these are seen as continuation patterns that suggest the upward trend will resume. Especially in Bollinger Band readings supported by volume analysis, if the pullback happens with low volume, it shows that investors are holding their positions and that selling pressure is weak. In this case, the probability of the price rising again after the pullback becomes quite high. Investors generally prefer trading in the direction of the trend, and short-term corrections are often seen as new buying opportunities. Another important aspect of the Bollinger Band system is the tendency of the bands to expand or contract. When the price rises above the upper band and then pulls back, if the bands remain open, indicating high volatility, it shows the market is still dynamic. If the bands begin to contract, it may suggest a pause or indecision in the market. Therefore, during this pullback, it's important to watch whether the bands continue to expand. If they do, it strengthens the idea that this is merely a temporary breather and that the price may rise toward the upper band again. This technical setup, where the price breaks the upper band, is also very important for long-term investors. These types of movements provide crucial insight into the trend's direction and strength. If the price pulls back after surpassing the upper band, but doesn't fall below the middle band and then quickly rises again, this may mark the beginning of what's called a band walk. A band walk refers to a price movement that continues to rise parallel to the upper band and is often a strong signal of a bullish market. Therefore, investors should view such pullbacks as opportunities and adjust their positions accordingly to take advantage of the continuation of the uptrend. Another positive aspect of the pullback following a move above the upper band is the testing of psychological support levels. Market participants may place buy orders at certain price levels based on both technical and psychological considerations. When the price drops after reaching the upper band, these orders are triggered and the market gathers strength for another rally. This also indicates that participants are holding their positions and that confidence in the market remains intact. Moreover, one feature of the Bollinger Bands is the tendency for prices to revert back inside the bands after moving outside of them. This makes the pullback not necessarily a bearish signal, but more of a reversion toward the mean. This doesn't indicate the end of a trend. Rather, it shows that momentum has temporarily weakened and the market is trying to stabilize before deciding on its next direction. In this context, a slight pullback after the price reaches or exceeds the upper band is entirely natural and healthy. Such pullbacks offer opportunities for new buyers to enter positions. They also pave the way for a more stable and sustainable price increase without creating panic in the market. Especially for medium and long-term investors, these types of corrections can present unique timing opportunities to join the trend. In conclusion, a pullback after the price surpasses the upper Bollinger Band should not be seen as a weakness, but rather as a preparation phase for a healthier rally. If the price regains strength after this movement and buyers step back in, it is very likely to see another price move toward the upper band. Success in technical analysis depends on the ability to interpret such temporary movements correctly and to focus on the bigger picture. Therefore, this pullback may not be a signal of a downtrend, but could actually be a precursor to a larger bullish move. The patience and strategic approach required by this technical setup can provide investors with high potential returns.
The Elliott wave theory is an extremely powerful analytical tool that explains the psychological cycles inherent in price movements in financial markets. According to this theory, prices move in a 5-wave upward trend impulse followed by a 3-wave correction, ABC. Within this 5-wave impulse trend, the third wave is typically considered the longest, strongest, and most volume-driven upward move, during which the majority of market participants join the trend. In the case of the currently analyzed asset, it appears that the price is in this third wave, which may indicate significant potential for an upward move from an investor's perspective. If the asset is indeed in the third wave, and this wave has the potential to extend to the 3.272 Fibonacci extension level, then the price could rise by approximately 370% if this scenario materializes. Such a significant increase is not only important in terms of short-term speculative gains, but also in strengthening the long-term trend. At this point, understanding why the third wave can be so powerful is valuable from both a technical and psychological perspective. The foundation of Elliott wave theory lies in the influence of human psychology on the market. The first wave typically marks the beginning of a new trend, as the market begins to show signs of recovery after a prior decline. However, most investors believe this new move is a false signal. The second wave corrects the initial rise, and many market participants still act under a bearish mindset. But when the third wave begins, everything changes. Prices start to surpass previous highs, attracting more investors. The trend becomes more visible. Institutional investors, large funds, and trend-following strategies become active. This is why the third wave is usually the most volume-heavy and steep upward wave. In the current scenario, it is predicted that the third wave is ongoing and that the price could reach the 3.272 Fibonacci extension level. This Fibonacci level is often used as a target in third wave analysis, and reaching it signals serious momentum and widespread investor agreement on the bullish trend. Fibonacci extension levels play a critical role in identifying potential targets in strong trends. A 3.272 extension beyond commonly observed levels like 1.618 or 2.618 indicates a very strong trend and high investor confidence in it. A 370% price increase would require not only technical indicators but also simultaneous triggers from news flow, project developments, and investor interest. Such major increases are usually supported by a new update, a strong partnership, a major exchange listing, or significant macroeconomic developments. Therefore, technical analysis alone is not sufficient. It must be supported by fundamental analysis. However, confirming that the asset is indeed in the third wave and targeting the 3.272 Fibonacci level is highly valuable for investors in shaping their strategies accordingly. Moreover, trading volume should increase significantly during this period. The third wave is typically supported by the highest volume, as most investors start buying during this phase. If volume remains low, it may cast doubt on the sustainability of the rise. But as volume increases and market liquidity strengthens, the price is more likely to progress towards the 3.272 Fibonacci level. Another important factor to watch is psychological resistance levels. Before reaching such high extension targets, the price may undergo several correction moves. However, each of these corrections can be seen as a buying opportunity since the trend remains upward. It is also important to note that a 370% increase in the third wave requires investors to be patient. Such large waves develop over time and may last several weeks or even months, but the defining characteristic of the third wave is its sharper and more rapid rise compared to other waves. Therefore, entering positions at the right levels can yield substantial gains. In conclusion, If it is analyzed that the price is currently in the third Elliott wave, and this wave can extend up to the 3.272 Fibonacci level, this presents a very positive and promising outlook from a technical analysis perspective. During this period, investors should closely monitor both technical indicators and fundamental market developments, especially factors like increasing volume, RSI alignment, and the preservation of trend lines. Reaching the 3.272 Fibonacci level and realizing a 370% price increase would be a strong sign not only of technical momentum, but also of peak investor confidence in the project. Therefore, accurately interpreting the strength of the third wave and adjusting strategy accordingly can make a significant difference for investors.
Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analysis, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.